What's up you guys? Welcome to Mantravadis. I'm Surat Mantravadi. Okay, so you saw my previous video about why Roth IRA accounts are something that you must have. And you want to know what investment you should buy in your Roth IRA, especially since you learned that you should not leave it as cash. I answer that exactly in this video. The answer depends on what kind of investor you are and how much time you want to spend managing your investments. Stick around to find out. There are a lot of stocks, bonds, and other investment options in the market. An active investor picks and invests in only some of them, hopefully after some good research, because he or she thinks they'll generate a better return than others. A passive investor, on the other hand, buys a little bit of everything because they don't know which investments are good and which are bad, or because they are not interested. They have better things to do in life. Active investing is for you if you are an investing nerd. If you are the person who reads company annual reports and other SEC filings because you think it's more fun than watching Ozark on Netflix. When you think of God, the only images that come to mind are those of Warren Buffett, Jack Bogle, Philip Fisher, Benjamin Graham, John Templeton, Carl Icahn, Ray Dalio, or David Swenson. Do you think stock diversification is a contemptible idea meant only for the meek and ignorant? You are the kind of person who cannot utter a single sentence about investing without a reference to Warren Buffett because he said pretty much everything that there is to say about investing. If you are the kind of person who waits for 13F filings more eagerly than you would for sex, then you should be actively picking stocks. If you don't know what 13F is, well, that's an exaggeration, but only a little. Because active investing is more than a full-time activity if you want to do it well. It is a zero-sum game in which you will compete against some of the most ridiculously smart people in the world who have a lot of resources at their command, like an army of smart and driven analysts. Even if you decide to pick stocks for Roth account, you should not trade in penny stocks or other speculative investments like options or future. In your Roth IRA, you should definitely invest in high growth investments to take advantage of the tax shield that the account offers. But you're saving and investing in your Roth account for retirement, for the long term, and not to get rich quickly. Many of these penny stocks are headed for bankruptcy, are small or new companies with little or no following, or are businesses deep in debt that often trade at less than $1 per share and sometimes don't even file numbers with SEC. These are very high risk stocks that could easily and often go to zero. And you cannot use the losses you incur in your Roth account as a deduction and reduce your taxable income, or at least not fully, and it's not straightforward. So if you must invest in speculative investments, it is better to do it in a taxable account. If active stock picking is not for you, then invest in index funds. Index funds provide a way for investors, even with a small amount of money, to own a piece of the entire stock market and have true portfolio diversification instead of being stuck with the ability to buy only a small number of shares in one or two companies. If you don't want to bother yourself with all this investing stuff and just want to spend not more than 1 hour every year reviewing your investments, then you should invest in low stock index funds.
What? Index funds? Will I get a good return if I buy all the stocks in the market? I should be buying the good stocks and ignoring the bad ones, no?
Not really. It is hard to know which are the good ones and which are not. And it is exceptionally hard to stay disciplined and not buy or sell stocks at the wrong time, driven by fear or greed. People often underestimate how hard it is to stay unemotional when stocks are going through a roller coaster ride. Apart from being psychologically easier, if you invest in low-cost index funds, you can expect to get a better return than 96% of all the professionally managed mutual funds and maybe even hedge funds that charge a much higher fee. Okay, you say I'm sold on index funds. What should I actually invest in? The first thing you should know about is asset allocation. It is the proportions that you decide in advance of stocks, bonds, real estate, gold, and other asset classes in your total portfolio. Why invest in different asset classes? Why not just stick with one? That's because different asset classes do well in different economic seasons, and you don't know which season it is going to be next. That is especially true since you're not managing your money actively. You want a portfolio that does well when economy is doing well and when it is not, when the prices in the economy are going up and when they are going down. Having the right asset allocation will give you that portfolio. After you decide how much to save and invest, there are three variables or three factors which determine how well your investments do. One, low cost investments. Make sure your investments and funds have low fees. This makes a lot of difference in the long term, especially when you consider the power of compounding. Two, tax efficiency. And three, asset allocation. Everything else, the stock tips you get or don't, the market timing, is this a good time to invest or is this a bad time to invest, etc., matters way less. Low cost funds, tax efficiency, and asset allocation. Remember that. It is important to rebalance this portfolio once every year. Rebalancing is just getting back to the initial proportions of different asset classes you've decided to hold. For instance, if you've decided to invest 50% of your money in stocks and 50% in bonds, and say over the next year stocks double but bonds stay the same, your portfolio will have 67% in stocks and 33% in bonds. So you sell some stocks and buy bonds so that it becomes 50-50 again. That's rebalancing. The best asset allocation, that is the asset allocation that will give you the most return with the least possible risk over a long period of time for a passive investor, is what Ray Dalio calls all seasons portfolio. In this portfolio, you invest 30% in stock index, something like an S&P 500, 55% in bonds, 15% of which will be in medium-term bonds and 40% will be in long-term bonds. The remaining 15% will be split equally between commodities and gold. I'll make another video on how to set this portfolio. It's quite straightforward. If you don't want to think about investments at all and you just want to set and forget it, then invest in target date funds. In target date funds, you just pick the retirement year and the fund will take care of the asset allocation for you. The closer you get to retirement, the more conservative the portfolio will be. Bonds are considered to be less risky, so you would have a lot more invested in bonds as you get closer to your retirement. So with this option, you don't have to worry about asset allocation. The target date funds will manage and rebalance the portfolio for you. Let's look at an example. Let us look at Vanguard Target Retirement Fund, VTIVX. You would consider this fund if you're retiring in between 2043 and 2047. It currently has 89.4% of its portfolio in stock index funds and the remaining 10.6% in bond index funds. As 2045 approaches, the fund would have a lot less than 89% invested in stock funds and a lot more than 11% invested in bond funds. But the problem with target date funds is high fees, unless you invest with Vanguard, which has the lowest fees. The other problem is that even if you choose the most conservative Vanguard target date fund, they are a lot riskier, especially when compared to a Ray Dalio's all-season fund, but only generate a marginally better return. For instance, the VTIVX, since its inception, since October 2003, has returned 8.7% per year before taxes compared to Ray Dalio's 9.2% since July 2002. Though all seasons portfolio has a slightly lower return, its risk is a lot less. In 2008, because of the financial crisis, VTIVX lost 34.56% of its value. But the all seasons portfolio actually gained 1.34% in 2008. All seasons portfolio's worst return over the past 75 years was minus 3.93%. I may do another detailed video on target date funds. Let me know in the comments below. Having said that, investing in target date funds is surely better than leaving it as cash or investing in ultra low return investments like short-term bonds, money market funds, CDs, etc. A 5-year CD will get you a 1% return per year. What's the point of a tax shield if you're going to get such low returns? That is the reason why you should not open a Roth IRA account with the bank, as they only have such low return investment options. Target date funds are the lesser of the two evils, but You must invest with a low-fee fund like those of Vanguard. I'll leave links to All Seasons Portfolio and Vanguard's VTIVX below. I'm not affiliated with any of these companies and have nothing to sell you. I just did my research and I'm sharing it with you. Alright, so you have it. If you're really into investing and are willing to do it full-time, pick stocks actively. The vast majority of people who are not into investing should invest in index funds and make sure they have the right asset allocation. Ray Dalio's All Seasons Portfolio is a great option, but there are other good asset allocations as well. If you just want to set it and forget it and don't mind the high risk and the high fees involved, then invest your money in Roth IRA in target date funds. Whichever option you choose, please don't invest in low return investments like money market funds or CDs, and don't invest in speculative investments like penny stocks or options in Roth account. Thank you for staying till the end. If you're liking this content, let the YouTube algorithm know it by hitting the like button and consider subscribing. See you next time.